Hey there, Joel here with the Richards Mortgage Group by Quantus Mortgage Solutions. And today I just wanted to take a minute to talk to you all about mortgage interest rates and a common misconception that I frequently deal with. So a question that I get all the time is, what's your best interest rate? And typically when people say this, they mean, what's your lowest rate? And maybe they've seen an ad online or they've seen something on TV and they want to know if I can match that rate or do better. And the truth is I probably have access to the same or very similar rates, although this question actually represents a more fundamental misunderstanding about interest rates. So it would be a little bit disingenuous for me to just answer with the lowest rate I have access to, when in reality, interest rates are prices, not the product itself. And so sometimes you get what you pay for, or sometimes it's worth paying more to get a better product. The product itself with a mortgage is the right to borrow a specific amount of money and pay it back over a certain amount of time, and the terms and conditions within that contract that sort of lay out your rights and responsibilities in doing so. And there can be a lot going on under the hood of that contract. The mortgages with the simplest rates tend to have simpler contracts with less features and functions, and they might have more restrictive terms with the contract as well. So with that in mind, I've created a list of 6 reasons why the best mortgage for you might not be the one with the lowest interest rate. And those 6 reasons are payout penalties, prepayment privileges, features and different lending programs, different underwriting criteria, insured versus uninsured lending, and lender response time. So let's get into it now. I'm going to go over each one of these really quickly, and you can always read about it more in depth on the blog that's related to this video on our website, richardsmortgagegroup.ca/articles, which is where you'll find our blog. So reason 1, payout penalties. The mortgages that tend to be offered as low rate value, sort of no extra type mortgages, they tend to have really restrictive payout penalties. So even though you have a lower interest rate, they get you on the back end. If you ever have to pay your mortgage out early and break that contract, you have to pay what's called a payout penalty. So it's a common misconception that you can just sell your home at any time and pay out your mortgage at any time and just go about your way. In reality, if you pay out your mortgage or break that contract in between the predetermined renewal intervals, then you have to pay a payout penalty typically. And these can get quite high. So those low interest rate mortgages tend to have higher payout penalties, even though they have lower rates, and that's how they get you. The big banks in Canada are also notorious for having really bad payout penalties. So in any given lending niche in the market, they tend to outcompete other lenders on rate, so offer lower rates. But then in the contract hidden in there, they'll have much higher, more restrictive payout penalties, and they make their money from you on the back end. So that's reason number 1. Reason number 2 is prepayment privileges. So again, the sort of low rate value type mortgages, these tend to not offer much in terms of prepayment privileges, which means that once you sign the contract and you're locked into a particular payment schedule, you are pretty much locked in. You have very little flexibility when it comes to making additional payments against the mortgage. So if you have extra savings that come into your life, you can't put them against the mortgage very easily and pay down your balance more. You're locked into that inflexible payment plan, even though your interest rate might be low. Versus with a more full feature mortgage, you might pay a little bit more for an interest rate, but you typically have more in terms of prepayment privileges, which means that typically you can pay a certain percentage in addition to your regularly scheduled payments against your balance each year. And this is really a good strategy to pay down your mortgage quickly, because those payments go directly against your balance rather than going towards paying interest. Prepayments are a really good strategy to pay down your mortgage quickly if that's something that's important to you. And these low rate mortgages can make it difficult to do so because they are inflexible when it comes to prepayment privileges. So reason number 3 why you might want to go with a mortgage that has a slightly higher interest rate than the lowest ones that are advertised on the market is because of different lending programs and special features and add-ons that are available at different price points. So you might be able to get the most basic, simple mortgage out there, but there's a lot more that you can do with a mortgage. So there's all sorts of different lending programs and features and add-ons that you can get access to. And just like any other product in the market, typically when there's more features and options and functionality in a product, it typically costs more than its competitors that might not have as many options. So some of the things that you can get with your mortgage are things like cash back mortgages, which gives you a percentage of money back after the mortgage funds, which you can use for moving costs or to settle other high interest debts that you might have. Or there's readvanceable lines of credit. So as you pay down your mortgage, you open up a line of credit balance on your home that's secured to your home. And so as you pay down that mortgage, you are able to then borrow back up again to a certain percentage of a limit. And it's a really good and quick and easy and cheap way to access equity in your home as you pay down the mortgage. There's also purchase plus improvement programs. I always struggle to say that one. So you can roll in the cost of immediately after purchase renovations in your home into that mortgage. So you can buy a home with good bones that might need a new kitchen or some other cosmetic work to it, and you can roll the cost of those renovations into the mortgage. There's all sorts of other programs and features as well. So these are all different reasons why you might want to go with a mortgage that costs a bit more but gives you a lot more options and functionality. So reason number 4 that we're going to talk about is underwriting criteria. So different lenders and different lending programs have different criteria that they will and won't consider when they decide whether they'll take on a deal or not. And these different situations, financial situations, property objectives that you might find yourself in represent different risk profiles to the lender. And so for these different risk profiles, they need to be compensated for more or less risk that they take on. And so that is compensated for by the interest rate they charge. So for higher risk deals in the eyes of the lender, they're going to charge you, all things equal, a higher interest rate. So for people in certain situations such as self-employed or difficult to verify income, commission income, or people with less than perfect credit situations, or maybe foreign buyers, people trying to buy a non-conforming property or perhaps vacant land, these are all different situations that represent different risk profiles to the lender, and different underwriting criteria will apply. And so if you find yourself in one of those situations, the lower interest rates that are out there might not even apply to you. So for you, the best rate might be the rate that you can qualify for, or that your property can qualify for. There is also small nuances and differences in the underwriting criteria between different lenders. So if, for example, for one particular niche of lending, one lender can't do the deal, you might find a different lender that can do it under slightly different underwriting criteria. So that's another reason to consider going with one lender versus the other, and sometimes one will charge more or less of a rate. The 5th reason why the mortgage with the lowest rate might not be the best mortgage for you is the difference between insured and uninsured lending. So with insured lending, a third-party mortgage default insurer is going to come in and at the borrower's expense insure the loan for the lender to protect them in the event that the borrower doesn't pay their mortgage. So this reduces risk for the lender and allows them to offer a lower interest rate. And then that insurance premium, or that insurance is paid for by a lump sum premium that gets added to the balance of the mortgage. So even though the interest might be lower, you actually end up borrowing more in total, and so you rarely recoup the additional expense of that insurance through lower interest rate savings. So in certain situations, you'll be able to choose between insured or uninsured lending, and so if you do find yourself in a situation where you have the choice, it's typically better to go with the uninsured lending, even if the rate is slightly higher. For anybody that has less than 20% down, you're always going to require insured lending. That's just a government mandated rule. So anywhere between 5 and 20%, you're going to have that insurance premium. So it's not going to be as much of a choice for you. But for people with more than 20% down, there's certain situations that dictate insured versus uninsured. And then the 6th and final reason that the mortgage with the lowest interest rate might not be the best one for you is the issue of lender response time. So the lenders in any given niche or area of the market with the most competitive rates are going to be the busiest because they have the most competitive rates. So when time is of the essence, such as in a really hot buying market where sellers want to see really short financing windows, and there's a lot of competition for properties, you want to be able to move quickly. And so if there's a lender with a lower rate, but they're really busy, and so they have long document processing queues and they have long wait times to issue a lending commitment, it might be worthwhile to go with a different lender that might have a less competitive rate for that given product, but they might be less busy as well, so they'll be able to get to your application right away and issue a commitment much quicker, allowing you to close on a property much quicker and perhaps get a deal that you otherwise wouldn't be able to get. So there's a lot of different choices. It can all be pretty confusing, and a good mortgage broker can sort of help you navigate your way through all of these different decisions that you have to make. We can help sort of put things into perspective for you and help you feel confident about the decisions you make so you can move forward with clarity. So feel free to give me a call. It all starts with a conversation and about figuring out what your particular objectives are and what your particular situation is. And then we can kind of narrow in on what the best mortgage for you might be and what the best interest rate that is available to you within that specific subset of lending would be. So yeah, let me know. Happy to help. Have a great day.